So what do you do when an asset just plummets from this crazy parabolic high, triggers like massive sell signals across the board, and yet you still have these long-term holders screaming from the rooftops that it's, the most undervalued play of the decade?
I mean, you step back, right? Because you're basically staring at the ultimate market paradox. The chart looks like a sheer cliff face, but the underlying narrative, the industrial side, is telling you it's a launch pad.
Yeah. And reconciling those two realities is it's tearing the market apart right now.
Oh, absolutely. It's wild.
And that tension is exactly where we find ourselves today. So welcome to the deep dive. We are looking at the iShares Silver Trust, ticker symbol SLV, because as of today, April 21st, 2026, SLV just suffered this brutal, absolute gut punch of a one-day decline.
Yeah, over 5% in a single session. Yeah.
Exactly, over 5%. It dropped down to $68.49. So our mission for this deep dive is to, tear down the financials, rip apart the technical charts, and follow the big money moves.
Mhm.
We need to figure out if this falling trend is like a devastating value trap or, a generational buying opportunity.
Which is the exact question keeping portfolio managers awake at night right now. The stakes are just incredibly high, and the signals are, well, they're completely fractured.
Right, totally. But before we jump in, I have to state clearly that this conversation is just a natural debate. It's purely educational. Absolutely no financial advice is being given here.
Okay, definitely. Do your own research. Always.
Yeah. And before we really get going, compulsory call to action time. Make sure you like this video, subscribe to our YouTube channel, and leave your feedback in the comments. We genuinely want to know where you stand on this.
Yeah, the comments are going to be interesting on this one.
Well, for sure. Okay, so before we even look at a single chart or try to interpret these signals, we need to understand the unique financial anatomy of what is actually tumbling in price here.
Right, because SLV is not a normal stock.
Exactly. If you open your brokerage app right now and try to evaluate SLV, like, say, Apple or Microsoft, you are going to be incredibly confused. Because usually when we see a massive drop, what's the first thing we do? We pull up the income statement.
Quarterly earnings, yeah.
Right, quarterly earnings, annual revenue. We check the
Yep.
balance sheet for debt, run a cash flow analysis. But if you try to do that with SLV, you come up completely empty-handed.
Because looking for a balance sheet on SLV is like looking for a steering wheel on a horse. It just doesn't exist by design.
A steering wheel on a horse. I love that.
It's true. I mean, SLV is a grantor trust. It doesn't manufacture cars. It doesn't
Yeah.
sell software. It doesn't have a CEO sweating over quarterly profit margins. Its entire legal and structural existence is simply to hold physical silver in a vault.
Okay, so its quote-unquote financials aren't based on sales. They're based entirely on its net asset value, its NAV, and its physical holdings. And we really need to pause and comprehend the sheer scale of this thing.
Oh, the scale is massive.
Right. We're talking about roughly 15,280 tons of physical silver.
Tons, not ounces, tons.
Yeah, tons. It boasts total net assets of about $35.68 billion. That's billion with a B, with 542.55 million shares outstanding.
Hmm.
And they just charge this pretty minimal expense ratio of 0.50% to manage all that heavy metal.
And that structural reality, it fundamentally changes how this asset trades. Because it's an ETF, a trust, there are no traditional corporate insiders.
What do you mean, like no executives?
Exactly. You don't have a board of directors buying up shares to signal confidence or, a CEO dumping shares right before a bad quarter. The only thing dictating the daily price is the market's collective valuation of that physical metal.
Let me stop you there, because if there are no traditional earnings reports to anchor to, doesn't that mean SLV's price is entirely at the mercy of raw, unforgiving market sentiment? I mean, I look at this thing and I don't see a traditional company. I see a massive 15,000-ton digital vault.
Yes, you're hitting on the core vulnerability here. That lack of corporate earnings is exactly why technical analysis and momentum are weighted so heavily for this specific asset.
Because there's no PE ratio to fall back on.
Right, there's no earnings multiple. The value is literally just whatever the next buyer is willing to pay for a fractional ounce of silver today. So sentiment, trend lines, technicals, that becomes the primary language.
And if we look at the historical quote context, that sentiment is wildly unstable.
No, it's a roller coaster.
I mean, the volatility is staggering. Look at the 52-week low. It was sitting way down at $29.04. Then we saw this violent parabolic peak all the way up to $109.83 just a few months ago in January 2026.
A historic run.
Yeah, and now we are sitting at $68.49. So its sentiment is the steering wheel. Let's look at exactly what the technical indicators are screaming right now.
Well, they're screaming, but it's not a happy sound. The technical picture is just bleeding. It is unequivocally bearish in the short term. SLV is trapped in a short-term downtrend, and that downtrend is operating within an even wider falling channel.
So every time it tries to rally, it just hits a lower ceiling.
Exactly. The momentum indicators are backing that up, and they are flashing bright red. Let's look at the MACD, the moving average convergence divergence.
Which tracks trend direction and momentum, right?
Right now, the MACD is sitting at negative 0.62. That is a clear textbook sell signal. And then you have the RSI, the relative strength index.
Okay, let's talk about the RSI. On a 14-day tracking period, the RSI sits at 29.44. Now, anything under 30 is firmly in oversold or, bearish territory.
Yep. And when you map out the support and resistance levels on the chart, the walls are just rapidly closing in. You've got immediate resistance at $69.86. Above that, the 50-day simple moving average is acting as a heavy ceiling at $71.18, followed by a recent pivot top at $72.82.
Okay, wait, I want to challenge this narrative for a second. Let's unpack this. Let's go back to that RSI number sitting at 29.44.
Okay.
If an RSI of 29 means the asset is mathematically oversold, isn't human nature going to assume it's due for an automatic bounce? Like, is trying to catch that bounce exactly how retail traders get their fingers chopped off by a falling knife?
Oh, man, yes. That is exactly how amateur traders destroy their portfolios. Oversold does not mean cannot go lower.
Right.
It just means the downward momentum is stretched. In a calm market, sure, an RSI under 30 might trigger a bounce, but we are not in a calm market.
Right.
We have to look at the floor beneath the price.
You're talking about the support levels. We've got a pivot bottom at $66.69, but more importantly, the 200-day moving average.
Yes, the 200-day. Right now, that is sitting at $68.31. And for institutional traders and automated systems, that specific level is the critical last line of defense.
Wait, so the price is at $68.49, and the last line of defense is $68.31. That is dangerously close. What happens if it breaks below that?
If it breaks below $68.31, it violates a major long-term structural trend. And here's where the machines take over. Institutional algorithms are programmed to watch that exact line.
So they don't care about the RSI being oversold.
They don't care at all. A breakdown there triggers algorithmic selling automated stop losses that completely ignore oversold signals. They just flush the price down to protect capital.
So trying to buy right now just because the RSI looks low, it's like stepping in front of a freight train to pick up a quarter.
Precisely. And there is a lot of weight on that floor. The latest news in the order flow shows intense selling pressure. Volume just spiked to an enormous 30.4 million shares during this recent drop.
30.4 million shares. That's not just casual selling.
No, that volume spike is the tell. It's active, aggressive distribution. People are rushing for the exits.
Okay, so if retail traders are at risk of catching a falling knife, we really need to look at what the quote-unquote smart money is doing as the price approaches this floor. Who is absorbing that 30 million share volume?
This is where it gets fascinating, because if you examine the order flow behavior, you see large sell-offs consistently triggering whenever the price nears that $72 to $73 resistance zone. Big players are unloading their bags on every bounce.
Let's name names. Who is holding these bags?
Well, the major institutional players like JP Morgan Chase & Co. and Susquehanna International remain the absolute largest stakeholders in this trust.
But the recent 13F filings are showing some incredibly mixed signals, right?
Oh, a complete fracture. For anyone who doesn't know, a 13F is basically a legally mandated quarterly poker reveal for Wall Street whales. It lets us see what the big money is doing.
And what they're doing is totally contradicting each other. You have firms like Silver Oak Securities who recently doubled down. They increased their positions by 25%.
Yeah.
But then you have firms like Fiduciary Alliance who went the exact opposite way, trimming their holdings by 24%.
It's a tug of war. And that polarization in the 13F filings is perfectly mirrored in the professional analyst ratings. The outlooks are just entirely dependent on the time frame.
Let's lay those out because they sound a little crazy. In the short term, analysts are bearish. They project a painful range of $66 to $70 for the next 25 days.
Rough month ahead, yeah.
Right. But in the medium term, analysts at Amplify are neutral. They expect base building phase, predicting a floor between $70 and $80.
Okay.
And then you look long term, and JP Morgan is wildly bullish, predicting silver will average $81 an ounce by late 2026. So they're essentially telling us to jump onto a train that's currently moving backwards, because it might go forward next year.
That's a great way to put it.
How is a regular investor supposed to navigate a strong sell today versus an $81 target tomorrow?
You have to separate short-term momentum trading from long-term accumulation. The people selling right now, the ones driving that 30 million share volume, they are short-term risk managers.
They just see the technicals bleeding.
Exactly. They see the MACD flashing a sell signal, and their mandate is to exit today. They cannot afford to care about December. But the entities accumulating, like Silver Oak adding 25%, they are operating on a completely different macroeconomic framework.
Which brings us to the ultimate debate of this deep dive. Are we looking at an undervalued play or a value trap? Let's break down both sides, starting with the bear case.
The worst case continuation. Some call it the bubble popping.
Right. The core of the bear argument is that the January run to $110 was a parabolic event fueled by speculative exhaustion. It was fundamentally unsustainable.
Yeah, everyone who could buy had already bought.
Exactly. Combine that with massive macro headwinds, specifically a strengthening U.S. dollar and rising real yields.
And that is the wrecking ball. You have to understand how yields work against silver. It's about opportunity cost. When real yields rise, you can buy a government bond that pays you a guaranteed risk-free yield.
Right, you get paid to wait.
Exactly. But physical silver yields nothing. It pays no dividend. It just sits in a vault, costing you that 0.50% expense ratio. So historically, high yields absolutely crush non-yielding assets like silver. And because silver is priced in US dollars, a stronger dollar drives the nominal price down even further.
So because of the rapid price increase and high volatility, the bears say the asset remains overvalued relative to historical norms, even at $68.
Right. To them, $68 isn't cheap. It's just less expensive than a bubble.
Okay, but what about the bull case? The silver squeeze 2.0.
Ah, the bulls. They don't care about the paper market. They are looking at the physical reality. There is a very real structural supply deficit right now.
Industrial demand, right. Solar panels and EVs.
Yes. Both of those require vast amounts of highly conductive physical silver, and that industrial demand continues to aggressively outpace actual mine supply. Plus, you have geopolitical tensions in the Middle East and major mining regions, which just reinforces silver's safe haven appeal.
Okay, here's where it gets really interesting for me. We hear constantly about solar panels and EVs eating up global silver supply. But if the US dollar is acting like a wrecking ball and real yields are rising, does physical industrial demand even matter right now? Like, can macro gravity just crush the supply deficit narrative entirely?
That is the multi-billion-dollar question. You are weighing the unstoppable force of macroeconomics against the immovable object of industrial supply constraints.
The unstoppable force versus the immovable object.
Exactly. In the short term, macro gravity wins. The paper market is driven by algorithms and interest rates, and they're pushing the price down. But in the long term, you can't print physical silver. If miners stop digging because prices are too low, the physical shortage becomes so acute that industrial buyers who physically need the metal to make their products are forced to bid up the price, completely regardless of the US dollar.
But the downside risk right now is brutal. Let's talk about why retail traders often get trapped here.
It comes down to anchoring.
Right. People look at that $109.83 high from January, and they anchor their expectations to it. So when they see $68.49 today, they think it's a massive discount.
They think they're buying a dip, but they completely ignore the macroeconomic headwinds dragging the entire sector down. They ignore the extreme volatility, and they get caught in the trap.
Wow. Okay, so let's briefly recap this journey for everyone listening. We're looking at a trust holding over 15,000 tons of physical silver, teetering incredibly dangerously on its 200-day moving average of $68.31.
Literally pennies away.
Yeah. The short-term picture is highly volatile and bearish, littered with algorithmic sell signals. Yet, the long-term industrial fundamentals still paint a compelling bull case for late 2026.
It's the ultimate standoff.
It really is. So we want to leave you with a final provocative thought to mull over. If that $68.31 last line of defense shatters and macro headwinds keep howling, how low does the technical floor actually go before that industrial supply deficit finally forces a reckoning?
Yeah, will the paper market break the physical market or vice versa?
Exactly. Thank you so much for joining us on this deep dive. Stay curious, keep tracking those charts. And one final reminder, don't forget to like this video, subscribe to our channel, and let us know in the comments, are you seeing a squeeze or are you seeing a trap? We will catch you next time.